As we hear people every day yelling, the market is going to crash, that the bubble is about to burst, let's lay out the foundations of what we need to be aware of when it comes to market tops and bubbles. First of all, we have to admit that high debt levels is a serious situation, but de-dollarization is not happening anytime soon. The key fact most people miss is that stablecoin is reinforcing dollar dominance. Every stablecoin is essentially a claim backed by US treasuries. Instead of weakening the dollar, they act like pipelines that funnel global liquidity back into US debt. As debt keeps going up, you see asset prices hitting all-time highs, and they are still being priced in dollars as the Fed keeps printing and makes sure the dollar remains the settlement layer of the world. Second, don't obsess over bubble calls. Influencers and so-called experts you know of, they play the bubble game and trying to time the crash by calling it consistently. Morgan Housel, author of Psychology of Money, says, optimism sounds like a sales pitch. Pessimism sounds like someone trying to help you, and history proves it. Missing just the top 10 rally days in a cycle reduces your annual return by 10%, and that's even before compounding. Don't mean you don't do your rebalancing and hedging to your portfolio. Risk management is key to the stability of profitability, but somehow you got to stay invested and stay in the market. We can get more in depth in the know-how in our private community. Fourth, a high PE ratio doesn't mean a guaranteed collapse or necessary overvaluation. It means the market is pricing in future growth. When a new business model emerges, PE spikes high and then slowly comes down as the market matures. The real danger isn't high PE, but it's when growth expectations fail before earnings can catch up. A lot of people miss now is that earnings are actually surging. Unlike the dot-com bubble, where valuations ran ahead of fundamentals, today's growth stocks have real profit power behind them. AI is driving a generational earnings boom. That's why this moment looks less like a bubble and more like the early stages of a structural gold rush. In the first phase of AI, from 2025 to 2030, most of the earnings boost comes from cost takeout. Companies use AI to be cost effective, cut labor costs, automate processes, and improve efficiency. This pushes margins higher and creates short-term profit growth. Analysts can model this directly, which is why near-term forecasts look strong. But cost savings are finite. Once you squeeze efficiency, the growth curve flattens. The second phase begins after 2030. This is real adoption growth. AI is fully deployed across enterprises and starts creating new revenue streams. Entirely new business models emerge. Here, the upside is much bigger, but forecasts are more speculative. It depends on how fast adoption accelerates across industries. Fifth, new bull markets start with all-time highs. They don't begin at the bottom. They begin when the market breaks out above its old peak. They are confirmation of strength. Worth giving some thoughts to where we stand now, as everyone is screaming assets and equities are too expensive. Sixth, the bubble paradox. Ride it, don't deny it. George Soros once said, when I see a bubble forming, I rush in to buy, adding fuel to the fire. New markets and new technologies almost always come with bubbles. The AI and crypto market does show bubble-like signs, high valuations, media hype, mania phase momentum. But as long as adoption and liquidity remain strong, the bubble will only continue to last. Smart investors ride it wisely, but stay alert for the moment when momentum shifts and hedge downside. Last but not least, tops don't form in fear. Tops form when skepticism disappears and mania takes over. Everyone believes this time is different. They peak when liquidity and human psychology converge into pure mania. Until then, your job is simple. Think big and protect your downside.